Okay, we're talking about the number, chapters 5 through 8. And we left off in the 70s, and now it's the early 80s, and we've gotten inflation under control, and the interest rates are starting to come back down. So now the economy starts to take off, and the Dow Jones goes up 40% in 4 months at the end of 1982, and then it takes off again in 1983, goes up another 30%. And what happens was these corporate raiders come in and realize that stocks are undervalued. And so they borrow money, selling bonds and other things, to buy these companies, these undervalued companies. They turn them around and they make a big profit. And they're helped by tax laws because interest on these loans that they were using to buy out the companies was tax deductible, where if they had bought the company via equity, dividends are not tax deductible. So these corporators realize that there's a lot of undervalued companies out there. They buy them, they turn them around, and they make a lot of money. And the problem, though, is this couldn't go on forever. And the raiders, they buy out all the good valued companies, and they're a bunch of imitators flood the market, and they're trying to buy undervalued companies, but there's no more undervalued companies. So a lot of the later corporate raiders bought out companies, paid too high of prices, and then couldn't pay off their debt. So things went poorly, and that's what we learned with Wall Street. Is generally we take a good idea, we beat it to death, and until we destroy firm value. And there's also a change in strategy that occurred at the time too, and that's what companies paid dividends to their shareholders. And the high stock dividends were generally a sign of strength, that the company's performing well, they have the cash to pay out to shareholders. But during the 80s, during this time of corporate raiders, having a lot of cash made you a prime takeover target. So companies wanted to reinvest that cash in the business. And what they told investors was, let us hold on to the cash, not pay you dividends. Let's reinvest it in the stock, and then that'll give you greater stock appreciation when you sell the stock. So you'll make your money that way, more money that way than if we had paid you out as a dividend. So they stopped paying cash out, and they stopped, as dividends, they stopped hoarding cash, and that made them less attractive as a takeover target as well. But the problem with not paying dividends was, at some point when you were paying dividends, you had to come up with the cash to pay shareholders. Once they stopped paying dividends, and especially technology stocks just stopped paying dividends, then that could allow you the opportunity to inflate your net income artificially via fraud and never have to pay the piper, because you never had to come up with the cash to pay the shareholders. So that's one of the things that led to companies in the late 1990s be able to commit financial statement fraud, because they never actually had to show the cash. So getting back to the 80s, from 80 to 87, the number of individual investors went up by 20 million. Mutual fund shareholders went up by 50 million, and mutual fund assets went up by 136 billion. Investors were worried about another crash because the market grew so rapidly, so they got concerned about a bubble. And the Fed, what happened was they slowly cut interest rates, which increased people's confidence in the market. And commercial banks had a lot of cash that they were able to lend, and so investors stayed calm, and didn't actually lead to a stock market crash, even though there was a rapid increase in share value. So in these 1990s, the market really starts to boom because we're creating new technology. There's telecom stocks, biotech stocks, and others are doing extremely well. And you have Microsoft, where they become the industry standard in the software industry, and they have profits that increase to 2.2 billion. And all these new technology companies like Intel, Oracle, Dell, Sun, Cisco, IBM, everybody's wondering who's going to be the next Microsoft. And so they're investing heavily, investors are investing heavily in these companies, in these new technology companies. And what we learned from the 1920s is that we tend to overinvest in new technology, whether it's electricity or radios or cars. Now it's software and new technology. And so all this investment, this demand for these stock prices, we tend to overvalue these stocks and create bubbles, and that's where we're headed. There's a little bit of a slowdown in 1994, but because the U.S. was dominating in a lot of markets, in a lot of market segments, like Coke was dominating internationally in soda sales, the pharmaceutical companies in the U.S. are dominating Europe. Our information technology is better than anybody else, and the S&P goes up 40% after that, and the Dow Jones breaks 5,000 in 1995, and that's when things really start to take off. And what we find is investors are always looking for the next big thing. So they're going to find that in stock prices for technology stocks. And whenever there's unusually high returns, there's unusually high risk. And for some reason, we don't want to ever acknowledge that, and we create bubbles. So what people are doing is they're taking their money out of real estate, out of bonds, out of other investments, and they're putting it in technology stocks. And technology stocks are growing rapidly, but part of it is due to optimism about the technology, and the companies like Microsoft are performing well. But part of the increase in the share price is due simply to higher demand for those stocks. So as money is exiting other investments and moving into technology, there's greater demand, which leads to higher prices, but not necessarily that the company deserves to be higher prices. So there's more people trying to buy those companies. It's similar to the market for like baseball cards. Like the baseball card doesn't have any intrinsic value, but during certain times in its history, there's a lot of demand for certain cards, and it creates a value, even though the underlying card doesn't have any significant intrinsic value. And that's what's happening to technology stocks. There's incredible demand for these stocks, and even though the company's performance may not justify such high stock prices, because of the demand, the price is going up. And so we see that happen during this frenzy. And then in chapter 6, Berenson takes a step back to talk about how we became focused on the number, which is the consensus earnings forecast. And he starts off by explaining how research worked at large institutional investors. And these large institutional investors back in the 60s, they used commissions to support research. So what they did was, the way people bought and sold stock and they generated commissions was to give their clients, their investors, really good research about companies and how well they're going to perform. So they give them good stock tips and good advice. And if they got good research and the brokerage is able to show these investors, hey, this IBM stock is a really good buy for these reasons, and they give them a 20-page report on IBM and why it's going to be the next big thing, then they can generate interest in that stock, and then people buy it, and that generates commissions. So they had incentive to provide as much research as possible to their investors to get them excited about stocks and then to buy them, and that generates commissions. So there was a lot of focus back then on creating good research that you could provide to investors so that investors felt comfortable investing in stocks. And commissions from the sale of stock accounted for 35% of the industry's overall income. So they were highly dependent on these commission incomes, and the way that they generated commission income was by doing good research. But by 1990, commissions had provided only 60% of their industry, of the industry's overall revenue. That's partly because they deregulated the commissions, what you could charge for commissions, and so people were cutting their commissions, and there wasn't as much margin in that. And also, mergers and acquisitions became sort of the wave of the future for how they were able to make up lost business on their commissions. So companies were vying more and more for mergers and acquisition work than they were concerned about commissions and generating stock sales. So because they were trying to get more mergers and acquisition work, they wanted to write good research or say positive things about the companies that were potentially going to merge or do acquisitions so they could get their work and avoid saying negative things about them. And when companies were going to do an IPO, for example, initial public offering, then these brokerages wanted to say really good things about the IPO, and they wanted their research to be positive. So this decrease in emphasis on commissions and an increase in emphasis on work that you're doing for firms or the mergers and acquisitions and IPO generated an incentive to say positive things about these companies to acquire their business. And you weren't as concerned about being wrong in your research because the commission from your investors wasn't as big a part of your business. And so what the research analysts started doing was they were basically copying each other's research. And by this time, the internet's become available. So if a company does, if a brokerage does really good research on a particular company, they put that information out on the internet, and then everybody has it. So there's really no proprietary information at that point. And so what the research analysts primarily, what became their primary job is to predict what the earnings per share target, what the earnings per share was going to be at the end of the quarter and at the end of the year. And they used to, like back in the 60s, 70s, they might provide an estimate of what the earnings per share was going to be. So earnings per share might fall between $1.10 and $1.15. And that also sort of emphasized to investors that net income numbers was also a series of estimates. So it was hard to actually nail down net income to one specific number and your earnings per share number down to 1 cent. But what happened increasingly was that investors started to think that not investors, but analysts started to think that their job was to provide a point forecast for earnings per share. And so all these research analysts who are researching the various companies, so you might have Microsoft and have 20 analysts following them for the various brokerage houses, they started to predict, like, for example, what Microsoft's earnings per share was going to be. So they would say, all right, it's going to be $1.35. Another analyst would say $1.33. Another analyst would say $1.37. Then 3 more would say $1.35. And then you would have these services that would gather all these estimates together and take the average, and that would be the consensus analyst forecast, would be $1.35. So they would expect that the share price, the earnings per share price would come in at $1.35. And companies, they knew that these analysts were making these making these estimates, and if they didn't come in at $1.35, for example, then their stock price was going to be punished. And part of that was because they knew that the companies because the earnings per share number was based on a bunch of estimates. Earnings is made up of estimates of what bad debt expense was going to be, what inventory obsolescence expense was going to be. They have warranty, they have estimate what warranty expense is going to be. And so there's a bunch of estimates that go into what the net income number is. And if they were going to miss their earnings target as $1.35, maybe they dial back their estimate of their bad debt expense, and maybe they dial back their estimate of their warranty expense a little bit. Then by reducing their expenses in those areas a little bit, they're magically able to get the earnings that they need to get the $1.34.4 up to $1.34.5, which rounds up to $1.35, and now they've come right in at analyst expectations. So analysts knew that there was some fluctuation in their estimates of what their expenses and other things were going to be. And so if they missed their earnings target, and it was speculated to be $1.35, and they come in at $1.33 or $1.34, then the assumption was that they had no more dials to turn, and that they had to actually just miss earnings per share. So the company might be doing poorly than they're actually reporting, and so their stock price would drop because investors would be concerned. Well, they couldn't turn the dials they needed to get the earnings per share number that the analysts expected, so therefore they must be performing poorly. And that was going to revise their future expectations of the company, and so that caused their stock price to go down. But like in the past, they said the analysts sort of recognized that the earnings per share number was somewhat squishy because the net income number is all guided by estimates in terms of calculating what expenses and revenue are going to be. And so they would give a range, in the past they would give a range that the earnings per share target was going to fall within a certain range. But now they're pinpointing it to a certain number. And if you missed that number, then your stock price would really get hurt. And if you made it, then your stock price would take off because they said, well, look how well the company's performing, and that would bode well for the future. And so that would cause more optimism for the stock and cause the stock price to go up. Right? So there was a big penalty for missing the earnings forecast, the consensus earnings forecast versus hitting it. And so companies, they wanted to make sure that they always hit their earnings forecast number. So they were oftentimes guiding these estimates. They were talking to the analysts and saying, basically, here's what we think earnings per share is going to come in at. So they were spending a lot of time on the phone talking to analysts and trying to control that number so that it was a target that they could realistically reach. So they were manipulating the financial statements, and they were also sort of guiding the estimates to make sure that they always came in at what the analysts thought their target number was going to be, the earnings per share target number. The other thing that companies were able to do is they were able to provide options. So in Chapter 7, he spends a lot of time talking about compensation for management in the form of equity, specifically stock options. And this is a very controversial subject that demands a lot of attention. But essentially what would happen was, especially for technology companies, these new companies, they wouldn't have a lot of cash to pay CEOs, to pay CFOs, to pay professional managers. But what they had was a lot of authorized shares of stock that they could sell or offer as options. And the way the accounting rules worked back then is if, let's say you offered a CEO 1,000 stock options, if the stock option price was the price the stock was selling at that day, then the assumption was that you weren't really giving them anything of value, and you didn't have to recognize any expense for the value of the option. Because if they issued the option at $1 and that was the share price, was $1 per share, then management has the option to buy $1 per share. They buy a share of stock for $1 from the company themselves, or they could just go out on the market and buy it for $1. So just giving the management that option to buy that share at the share price on that day, what the assumption was that you're not really giving them anything of value, so there was no compensation expense to record on the income statement. The problem with that thinking was that would be true if the option only lasted for one day. So you had the option to buy the stock on the day the option was granted for the share price that day. And then the option expired at the end of the day. Well, that wasn't the case with the options. The options, you may have 5 years to buy the stock at that particular price. So the fact that you can buy it at the share price on the day that the option was given does not necessarily mean that the option didn't have any value, because they could buy it at that price for the next 5 years. So if the stock goes from $1 to $2 a year later, they still have the option to buy that share at $1. And so the fact that the option had a period before it expired, that period made the option more valuable. So you were actually giving them something of value, because if the stock price went up, then when the management exercises that stock option, then the company is losing out on what they could sell the stock for that day at the higher price. And when the management exercises the option, they only get the lower price. So they're losing equity in the company by issuing these stock options that the stock price does indeed go up in the future, and these options have a term that's lengthy. So be that as it may, the accounting rules still said that even if the option has a long term, if you issue the option and the option price is the same as the selling price that day, you didn't have to record any compensation expense. Now the FASB thought that's not really realistic, and the company is giving up something of value because they're giving up potential losses in equity by issuing these stock options that the stock price goes up in the future, and executives exercise these options. However, the big 6 accounting firms and the publicly traded firms did not want this in any shape or form. They did not want to expense the value of options, because essentially they could pay management compensation expense and not have to record any expense on their income statement. And that was ideal for small startup companies that didn't have a lot of cash and they weren't showing much income anyway, but they could pay their executives with stock options, and their executives were happy because they were getting paid, and they were happy because they didn't have to record any expense, and it made the company, and these struggling companies look if not profitable, that they had much lower losses. And because these stock options were basically free on the income statement, then everybody wanted to give up stock options to pay their executives. And their executives all wanted stock options because if you're working Silicon Valley, you think, well, the company I'm going to work for, whether it's Google or Pets.com or Webvan, you think they're the next big thing, and I'm going to get these options for this low price, and then the price is going to take off over the next few years, and then my options are going to be worth millions and millions of dollars. So executives were demanding options. The companies wanted to give them options because it didn't cost them anything. They didn't have to give up any cash, and they didn't have to show any expense on the income statement. And so everybody was issuing options as a way to compensate their executives. And you had people out there like Warren Buffett is saying, but if, hey, this can't possibly be. If these were free, if these options didn't really, were not really any significant compensation, that people wouldn't be taking them in lieu of cash. And we should be exercising some value related to this compensation expense for options when we grant these options. The problem, though, was coming up with what is the expense. Let's say that we decided we wanted to exercise, when we wanted to give these options and we wanted to record some compensation expense, how much of these options, how much are they actually valued at? Because let's say the stock price goes down and executives don't ever exercise these options, then there was no compensation expense because the executives never exercised the options. But if they go up, and let's say the stock price goes from $1 to $10, and they exercise their option to buy shares at $1 per share, when the company could have sold those same shares of stock to outsiders for $10 a share, then the company's potentially losing out on $9 in equity. But so how do you know what the stock price is going to do, and then consequently, how could you determine what the price of that option should be when you issue it to determine what the true compensation expense is for the company? Well, what happened was a couple of economists at the University of Chicago, Black and Scholes, came up with a model called the Black-Scholes model that allow you to value anything. And businesses used it to value their stock options. And basically what the Black-Scholes model said was what makes an option have value? Well, we talked about one is the term of the option, how long it lasts. Because obviously the longer you have to exercise that option, the more value it has. If you only have 1 day to exercise the option, it doesn't have a lot of value. But if you have 10 years to exercise the option, then it has more value. So one of the things that determines the value of the option is the term of the option. The other thing is the volatility of the stock. So stocks that go up and down are more valuable because if you get the option at a certain price and that price fluctuates, and you can exercise the option anytime, then you just wait until it fluctuates and it goes up, and then you exercise the option. So you need some type of volatility in the stock for the stock to have value. You can't have it stay flat. And then the other thing that causes it to have value is if it pays a dividend, right? If you can exercise that option and get a dividend, then it's going to have value. So they said there's several things, and we put all those things in to a model, and we throw them all in, and the Black-Scholes valuation model came up with a value. So it'd say this option's worth 5 cents, this option's worth 10 cents. And so now we felt like we had the valuation problem solved. We know that the true value wasn't going to be exactly what the Black-Scholes model said, but at least it was a way to come up with an estimate. And we know that financial statements are a series of estimates, and this is just one more estimate to estimate an expense. Just like we estimate bad debt expense, we estimate warranty expense, we estimate obsolescence expense. There's a lot of expenses that we estimated, and this is just one more. And so there's a lot of concern among some investors and policymakers that we ought to be exercising the value of these options. And now we have a way to value them. So let's just record the expense. And because of the lobby by the Big Six and all these publicly traded firms, in fact, the firms in California and Silicon Valley were lobbying Congress and their senators to actually pass a law that says FASB could not issue any standards that said you had to value stock options expense. So they were getting politics involved in accounting standards. It was like a crazy time. And so the FASB backed down, the SEC backed down, didn't force companies to value these stock options. What the compromise they reached was, okay, you don't have to actually recognize the value of the options on the income statement. However, you do have to put in the footnotes what the value of those options would be if you did recognize them. So what you would have is a net income number that was one thing. Then you had a footnote in the back of the financial statements that said, if we were going to value these options, this is what the value of the option would be, and our net income would go down by this amount. And they said that should appease everybody, because if you're an investor that's worried about the value of the options, you can just look at the footnote and see what that value is, and then think about net income as that lower number. If you don't care about the value of options, then you just use the net income number. So everybody should be happy. And that was the position that the FASB took, was you didn't have to actually record it on the income statement, but you did have to report what income would look like if you had valued those options. And so people just kept giving out options more and more. And in some ways, they also felt like giving options was a useful compensation tool, because in the past they'd given out, like we'd seen in the 70s and 80s, companies had given their executives cash in the terms of salary, and if they ran the company to the ground, they still got to keep their cash salary. And so there was some thinking that, well, if we give them less cash but give them stock options or stock in the company, give them equity-based compensation, then their salary, their compensation is going to be based on how well the stock price performs, which is what investors care about. So theoretically, this should cause CEOs to not think short term, but to try and grow the company's stock, to make decisions that grow the company and improve the stock price. And if they're doing that, then they're going to make investors happy and make themselves happy. And so their incentives are going to be perfectly aligned by giving them equity-based compensation versus cash-based compensation. The problem, though, with that thinking was, if you give them a lot of equity-based compensation, especially stock options, then the way that their compensation becomes valuable is by focusing on the share price and trying to do everything to increase the share price. Well, if the share price wasn't tied into earnings per share and the accounting numbers that were reported, that would be a great plan, except the share price, as we talked about, is tied in to the value of the value of the share price tied into what you report as net income. And if you have the ability to manipulate income, then you have the ability to manipulate your own personal compensation through manipulating the financial statements. So creating this equity-based compensation and giving executives a lot of stock options created an incentive that companies had to manipulate the financial statements if they couldn't increase the share price sort of organically through company growth, and they could manufacture growth in the financial statements by fraudulent reporting and still get that high share price and still increase their compensation. So options in theory were a good idea, but in practice they just provided incentives for management to manipulate net income. And since management didn't have to pay dividends, they never had to come up with the cash. They had incentive to increase their own personal wealth by manipulating net income. And they never had to show the cash coming in the door because they didn't have to pay dividends. So these stock options created a problem for companies, an incentive to commit fraud. The other thing that Berenson spends a lot of time talking about are accountants in general. And Chapter 8 is called Accountants at the Trough. And he's pretty harsh on accountants, probably a little more so than I think is necessary. But that doesn't mean that his points are not valid. And he pointed out that in the past, going back to like the 60s and 70s, people who worked in public accounting that worked at these as external auditors were generally people who were good accountants. They were risk averse. They were just hardworking folks who enjoyed accounting. They were just trying to do a good job in their profession. And their compensation was based on your seniority at the firm. So there wasn't any competition to steal clients. In fact, the AICPA, the American Institute of Certified Public Accountants, had rules that prohibited certain types of advertising and sort of prohibited stealing people's audit clients. They felt like that was sort of bad form, that the external audit was a public service, and auditors shouldn't be competing for jobs. They should be doing their very best at the jobs, at the clients they already have. And it was perceived to be sort of ungentlemanly to be trying to steal other people's clients and advertising, and they didn't want to give the perception that they were like lawyers and ambulance chasers. That they did a solid public service. They audited the companies that they had, and they even mentioned, an anecdote in the book where partner one of the big CPA firms said, "Hey, if somebody came to me and was complaining about their auditor, I wouldn't try and steal the work. I would go tell their auditor, hey, these guys are complaining about you." Right? So it's perceived to be a gentlemanly profession, and that stealing clients was frowned upon. Competition was frowned upon. And the way that partners were compensated was just based on seniority. So the longer you were with the firm, the perception was you were a better auditor because you had more experience, and so you received a higher compensation. So as your tenure at the firm was greater, your compensation increased. However, during that time, and there were 8 big accounting firms, but in the late 70s, the Federal Trade Commission, the antitrust investigation, looked into the fact that these big 8 firms appeared to have an oligopoly, and they weren't fighting for competition, fighting for business. There wasn't any competition in the market. And the fact that the AICPA had these rules that sort of prohibited advertising and stealing other people's clients was sort of anti-competitive. So they encouraged the AICPA to change those rules and allow companies the big 8 audit firms to be more competitive and to try and steal each other's business. So consequently, profit margins went down because now you're worried about one of the other big 7 firms stealing your business, and if they were willing to offer a lower price, then you had to match it and charge lower audit fees. So profit margins were shrinking once people started to steal each other's business and start to advertise and try and take clients from each other. And so to look for ways to increase their revenue due to these shrinking profits from the audits, these big 8 accounting firms realized that they could do other things than just external audit. They could consult. They'd always sort of done tax work, but they could provide tax consulting. They could provide consulting on IT. So if you were running, Peachtree, a small accounting software package, and you wanted to upgrade to, Oracle or PeopleSoft, that the accounting firm said, we can hire people, IT specialists, to go help you make that transition, that implementation. And part of that's tied into the accounting numbers. So it sort of makes sense that we hire IT people to help you make that transition to upgrade your software packages. And so that was one consulting service that they went into. They would provide mergers and acquisition consulting. There was all types of business that they could provide consulting services for. And they realized that the growth in the audit market probably wasn't going to happen. In fact, margins were shrinking. So they started to grow their consulting business. And what they did is they used their relationships as the external auditor to sell these other services. And there started to be some concern that as their consulting business grew, that created it sort of created and impaired the auditor's independence, because the company's viability as a potential consulting target would go down if the company started to perform poorly, right? So there was incentive to have the company continue to report good profits and look good, so that they could also support these consulting fees for the audit firms. So the consulting business became an increasingly larger part of audit firm business. And so rather than doing the audit and then doing some consulting on the side, they were using the audit to sort of get their hands into the business and sell consulting services. And the SEC starts getting concerned, and others start getting concerned and saying this move to consulting is sort of impairing your independence as an auditor, because now you're actually worried about the financial health of this company, not just that they're reporting properly, but they actually look good so that you can sell consulting services to this business. And also the business could potentially blackmail you as the auditor by saying, hey, you've got these really high consulting fees that we're giving you as well. If you don't like our accounting treatment, we could take our not only our audit but our consulting fees to another one of the big eight if you don't sort of come to our understanding of how GAAP should be applied. So the fact that they were paying these consulting fees and the auditors didn't want to lose those fees created the perception that the auditor would be less could be less stringent on the audit standards and provide a lot more flexibility and potential to manipulate the financial statements. So there was some significant concern about these consulting fees. And consequently, as consulting revenue went up and partners could start to steal each other's business, so if somebody did complain about their auditor, the partner could say, well, why don't we audit you? And they could steal the business and bring in new work. So the audit firms started to change their compensation structure. And they would say, okay, well, not only is your pay going to be tied to your tenure at the firm, it's also going to be tied to how much business you can bring in. So it wasn't good enough just to be a good auditor. You had to be able to bring in significant revenue to the firm by going out and being a salesperson and bringing in new audit clients, stealing audit clients from others. And not only that, the consulting fees started to grow significantly. And the consulting partners didn't have that same concern with independence, and so they were trying to bring in as much business as they possibly could. So of course they were being compensated on how much business they could bring in, and it became a little bit cutthroat within the big eight firm as the audit partners were trying to sell consulting services. The consulting services were trying to get more work from the audit partners. The audit partners realized that they weren't going to get paid unless they could bring in more services and sell consulting fees. And the way to sell consulting fees was potentially to be a little lax on the audit so that the firms would like you and be interested in continue to use your firm for other things. And Arthur Andersen became the most aggressive at it. Their consulting side, the Andersen Consulting, got to be enormous. And it started to drive the thinking at the firm. And during that time, the firms started to merge. So Ernst & Young and Arthur Young merged. Deloitte Haskins and Sells merged with Touche Ross. He went down from 8 big 8 firms to 6. Now you have 6 big 6 firms. Right? And they became full-fledged professional services firms. So audit was only a portion of what they did. These consulting fees were significant. And there was a lot of competition between the consulting partners and the audit partners. And in the 90s, Andersen, their consulting business became so big at Andersen Consulting that the general partnership sort of overruled their quality control partners on some issues related to accounting. And that was sort of the first time that had ever happened. And we started to see an increase in restatements, companies that had to restate their financial statements because they were incorrect the first time. And so we started to see what appears to be lax auditing. And then it turns out that there was 3 sort of major frauds in the mid-90s. There was Cendant, Oxford Health Plans, and Sunbeam. And you can read about these examples in the book, but they're all evidence of big shenanigans that companies are pulling in their financial statements. And so there gets to be some serious concern that maybe auditing is getting a little lax, and that there are some problems at these audit firms, and maybe their independence is impaired. And so there's in 1997 an Independent Standards Boards Commission to sort of look at consulting and if consulting is really impairing auditor independence. And the SECs really want to get an answer to this and find out if they need to do something to crack down on these high consulting fees. And during that time, Price Waterhouse merges with Coopers and Lybrand. This is actually when I was auditing. And they formed PwC. So now we're down from the big 6 to the big 5. And what happens is in the early 2000s, the Independent Standards Board decides that, maybe independence is being impaired, but probably not. And let's just compromise. So just like there was a compromise on the expenses of stock options, they came with a compromise with consulting fees. They said they weren't going to ban auditors from doing consulting. And that was the Big Five was lobbying hard to avoid a ban on consulting fees because that's where their growth in the firm was coming from. But they did have to report in the financial statements what their consulting fees were relative to their audit fees. That way you could get a sense of how much consulting they were doing at an individual audit client. So the audit client had to report, this is how much we paid for consulting, this is how much we paid for the audit. That way if investors thought it was a problem, the independence was impaired, at least they had that information to make informed decisions. And so the separation of consulting from audit never happened. And firms could continue to consult as long as they just disclosed those fees. And it became a little bit of an interesting proposition because what happened was Andersen Consulting, like I said, was the most aggressive of all these firms. And their culture became a little bit cutthroat. And they wanted to break away from the audit partners because they said, why are we paying these audit partners who had been here a long time? All these, like sharing our revenue with them when we're the ones who's driving all the growth in the business. And the audit partners said, well, the reason why you're driving the bus in terms of your growth is because of the name, the Andersen name. And that's the name for quality and reputation that we've developed over all these years. So you can't break away from us. You know, your success is tied into the reputation that we've built. So you need to continue to share your revenue with us. Of course, the Andersen consulting partners didn't like that. So what happened was the audit partners started up their own business. They started up Arthur Andersen Consulting. So now there was Andersen Consulting that was part of Arthur Andersen. And then there was another consulting division called Arthur Andersen Consulting. And they were competing against each other. And then the Andersen Consulting side said, all right, we just want to break away from Andersen altogether. And obviously the audit partners said, not so fast, because that was sort of their cash cow was the Andersen Consulting fees that they were bringing in and sharing with the audit partners. And so Andersen Consulting basically said, okay, we don't agree on how much we have to pay to buy out. Let's take it to court. So it turns out what the court ruled was, okay, Andersen Consulting partners, you don't have to pay a huge fee to break off from the audit partners. However, you can't use the Andersen name. So you need to change your name if you're going to do that. So the Andersen Consulting partners said fine. And they changed their name to Accenture. And then it was 6 or 8 months later is when Enron happened. And then ultimately Andersen goes down. And of course, Accenture was thinking, well, Andersen, who are those guys? We don't know who those guys are. Right? And so they're actually fortunate that they were forced to change their name when they separated from Arthur Andersen. And now Accenture is huge and Arthur Andersen's gone. But it's sort of an interesting thing the way it played out. And consulting was in some ways driving the bus. And it was the fact that auditors had to compete on price and that audit became sort of a commodity. And everybody was trying to increase their consulting revenue. And the way the compensation structure was changed at these firms, that is actually the highest paid auditors were not the ones who were doing the best audits, but the ones who were selling the most services. And so selling services became more important at the firm than being a good auditor. And consequently, you see the problems that we had at Andersen. So even though I don't think Berenson is exactly right, or at least the implications that he makes in the book and disparaging sort of history that he gives of accountants, I don't think it played out exactly that way, but there was a lot of truth to what he says in chapter 8. So we'll end there, and then we'll pick up with the final chapter next week.